An excellent approach to accumulating wealth is through real estate, but many would-be investors think they can invest in real estate because they don't have a lot of money. Although having a lot of money is highly favorable, it is in no way necessary to become an investor. As such, I'll explain how to use other people's money to buy real estate to you. Now, using someone else's money means not investing your funds in a real estate transaction. You can achieve this by taking on debt or selling equity in a home. Most investors use hard-earned money loans to buy properties, but there are several additional ways to use other people's money. So, in today's video, I'll cover some effective techniques you can apply to use other people's money to buy real estate. Since you are ready, let's dive in. Hard money loans. Hard money is a great way to use other people's money and a credible alternative to standard finance like obtaining a 30-year mortgage from a bank. Furthermore, hard does not equate to challenging. Instead, it indicates that these lenders are only focused on the actual property or the hard asset. Traditional lenders have requirements for the borrower's soft assets such as proof of funds, pay stubs, 2 years of steady employment, good credit, etc. Hard money lenders don't worry themselves with this. These lenders examine the property and evaluate its future use. The estimated after-repair value of a property serves as the foundations for their lending decision. Real estate investors can benefit from this system in two important ways. First off, even if you have bad credit, you can still get a hard money loan. However, lenders are unlikely to engage with you if you have bankruptcies or judgment on your credit history. Second, hard money loans are perfect for fix and flip investors since they may be used for distressed homes. Hard money loans feature higher interest rates than conventional mortgages because of the higher risk and shorter period involved. You can anticipate an interest rate ranging from 7.99% to over 15% depending on your past investing experience and the quality of the contract. Investors can, however, also close these loans very fast. The normal closing time for conventional mortgages is 45 days or more. A hard money loan can be completed in just a week or two. Business partners and investors. One of the main ways that other people's money is used is through this option. In other words, you can look for outside investors or business partners to help finance a real estate deal. Many people wish to invest in real estate but lack the time or knowledge to do it. You may be able to add someone as a limited or money partner if they have money to invest. These people provide money, have no part in daily operations, and get paid back for their investments. Yes, you will have to give up some of your return, but bringing on a partner can be a great alternative if it means the difference between funding a deal or not. Many new investors also collaborate with more seasoned ones. These more seasoned investors typically choose to invest without having to deal with the day-to-day tasks. They can also offer suggestions and leadership while yet letting you carry out the transaction and learn from it. The Subject to method. Subject to is a method of purchasing real estate where the buyer agrees to take over the payments on an existing mortgage, while the seller transfers ownership of the property to the buyer. This means that the buyer becomes responsible for paying off the mortgage, but the mortgage and the loan remain in the same name of the previous owner. This method of purchasing real estate can be a great opportunity for buyers, especially those who may not have the credit or financial qualifications to secure a traditional mortgage. Because the buyer is not applying for a new mortgage, there is no need for a credit check or a mortgage application. Another advantage of purchasing a property subject to is that it can be a way to buy pre-foreclosures from a seller before the bank forecloses on them. These properties may be sold at a discounted price, as the seller is motivated to get rid of the property quickly to avoid foreclosure. It's important to note that buying a property subject to also comes with certain risks. It's important to be well informed and to work with professionals to make sure you are making a good investment. Seller financing. Seller financing refers to situations where the seller of a property acts as the lender and provides financing to the buyer. This can take many forms, such as the seller providing a mortgage or a land contract, or the seller accepting a down payment and providing the remaining balance in the form of a loan. In seller financing, the buyer makes payments to the seller rather than to a bank or other financial institution. The seller may charge interest on the loan and may require the buyer to provide collateral such as a lien on the property. Seller financing can be a good option for buyers who may not be able to qualify for traditional financing due to a lack of credit or income. or for sellers who are willing to carry the financing to help sell their property. It's also a good option for buyers who have a hard time to get approved by a bank because they don't have a long credit history or their credit score is low. It's important to note that when a seller is financing a property, it's important for both parties to have a legal agreement in place, outlining the terms of the loan, the interest rate, and the repayment schedule. It's also important to consult a real estate attorney, accountant, or any other related professional to make sure that everything is done legally and correctly. Credit card financing. Credit card companies want your money. Therefore, if you are a responsible borrower, they'll offer you some very solid personal loan possibilities. Imagine you have a credit card with a $25,000 limit, but you only use $2,000 of it each month, always making your payments on time. There's a strong chance the credit card company may provide you with a personal loan with a pretty low interest rate to cover the gap between the credit you frequently use and your limit. This can be a great way to use someone else's credit card or corporate funds. Now, if you've had a credit card for a while and don't frequently use the full amount of your available credit, you have probably received an offer for a credit card loan. A trustworthy borrower can apply for and get a credit card loan quickly because credit card firms are already acquainted with your credit score and borrowing patterns. Additionally, when you use credit card financing, you don't forfeit your ownership stake in the transaction. Rather, you simply use other people's money. Yes, like with all real estate debt, you must eventually pay these loans back. However, you succeed as long as your deal anticipated returns outweigh the credit card loan's interest. Home equity loans. With a home equity loan, often known as a second mortgage, you borrow money using the equity in your property. More specifically, a home equity loan provides you with a single lump payment that you repay over time, just like your first mortgage. Home equity loans offer some measure of dependability in this regard. You'll fix an interest rate for the period, so each month's payments will be the same. You can obtain a home equity loan at far lower interest rates than you would with an unsecured loan, since a home equity loan uses your primary residence as collateral. Even though second mortgages often have slightly higher interest rates than primary ones, you'll still find that they provide much better terms than many other types of financing. HELOCS. HELOCs, also known as home equity lines of credit, are a fantastic way to borrow money from others. Investors frequently use the equity in their principal homes. Assume then that your property is worth $50,000. Although a lender might not offer a HELOC for the full amount, even if you manage to get a $25,000 HELOC, this gives you a ton of freedom when it comes to gap financing. Furthermore, HELOCs only charge interest on the funds that are drawn. You won't have to pay interest after the debt is paid in full. Once you spend the money from a home equity loan to pay off the debt, that's it. You are allowed to use a HELOC for as long as you like. Once your unpaid debt is cleared, you can use the entire credit limit once more. This essentially gives house flippers a revolving piggy bank of money to use for well-executed deals. Business LOCS. A business line of credit functions similarly to a HELOC in this regard. However, banks use the operations of your company to acquire a business LOC rather than your residential as collateral. Only investors who own a business have access to this option. However, a LOC secured by your profitable business's activities can be a fantastic financing choice if you have one. Now that your company is established, you may be able to obtain a line of credit for it that is not tied to your personal credit history. This might allow you to get money even if your credit is less than stellar. Government-backed loans and house hacking. Nowadays, it seems like there is a hack for everything, and housing is no exception. You might generate cash from a portion of your principal dwelling by house hacking. There is probably an additional bedroom in a single-family home, especially if the owner is a single person or a couple without children. You have the options of renting out an extra bedroom in addition to using it for storage or guests. To make money, home hacking allows you to rent out this extra bedroom to a tenant, who may be a friend or a carefully vetted candidate. The ultimate goal is to have this tenant pay your mortgage each month with their rent. All the money you would have paid to the bank each month when someone else began paying your mortgage payment on your primary residence can now be saved or used to make investments in other properties. What does this have to do with using other people's money then? You typically require at least 20% down for a conventional mortgage on an investment property. However, you can obtain a home loan for 0% to 3.5% down with government-backed mortgages for primary residences such as VA or FHA loans. Additionally, by using the house hacking strategy to convert this house into a partially rental property, you can get access to an additional 16.5% to 20% of financing. Leverage risks. While buying real estate entirely with borrowed funds can significantly boost your return on investment, there are some hazards involved. Like with all investments, the potential risk in real estate increases with a possible gain. Furthermore, even though borrowing money to purchase a property enhances your prospective returns, you are still exposed to market risk. Those who remember the Great Recessions are probably familiar with the term underwater mortgage. For those that are not familiar with it, a borrower is underwater on a mortgage when he or she owes more than the home is worth. Additionally, when this happens, you are no longer able to refinance the property and recover the entire existing loan debt when you sell. In conclusion, becoming a successful real estate investor does not always require a large amount of personal funds. Instead, experienced investors often utilize creative financing strategies such as using other people's money to purchase properties. This not only increases potential earnings but also allows for the conservation of personal funds for future investment opportunities. Please give this video a thumbs up, hit the subscribe button, and comment your thoughts for more great content about real estate.